Very interesting moment to have you on. We are just a day or two away from the end of what has been one of the worst quarters for M&A. I think, by our numbers, the worst quarter since 1998, which is a long time ago. Are we at the sort of the worst part of this? Is this the bottom? Does M&A improve from here on out?
Well, thanks for having me, Ed. Good to be with you. I do think we're at the bottom. There's no question this has been a challenging environment for M&A. Stepping back, we started this year on the heels of what I would call a 10-year bull market for M&A, and clearly we've seen a sharp pullback in activity this year, with M&A volumes down 50% year to date, and down in the last quarter, or this quarter, nearly 2/3. And so we're on track to be, as you say, one of the lowest M&A quarters in 20 years. And frankly, that's not surprising to see this kind of decline, right? Over the last few months, we've seen both acquirers and targets pull back from M&A as they grappled with the difficulties of the broader environment. When we talk to our clients, they clearly over this time, and probably rightly so, have been focused on their people, on their operations, and their liquidity. And on top of this tough environment, you've had a spike in market volatility, which, as you know, is always adding to the difficulty for deal makers. Now, all that being said, and the reason I'm optimistic, deals are still getting done by both private equity and corporates. And as you know, we spend a lot of time talking to CEOs and boards, and we started to see a significant pickup in client dialogue with respect to M&A transactions over what I would say are the last 3 or 4 weeks. And
well, Dusty, take us inside those conversations, because that's what's going to sort of, I suppose, entail how the rest of the year plays out. What are the CEOs saying? What are the boards saying? Is that confidence there to actually go out and execute?
Well, it is. I think what we're clearly hearing first and foremost is continues to be a high level of what I would call strategic ambition, although I think the strategic priorities have shifted. When we look back at past downturns, we've historically seen a significant amount of pent-up demand for M&A coming out of a downturn, and I think this case is going to be the same here. What we've seen is sensible deals tend to happen, and so there's a pent-up demand for transactions. You look at the vast majority of discussions went on hold as we went into this downturn, and we expect the majority of those transactions to come back over the next, let's call it 12 months. I think the good news is the financing markets themselves have largely recovered. We've seen both debt and equity issuance this year, which has been quite robust. And I think a lot of potential acquirers, both corporate and private equity, are in a good position and are looking to deploy equity capital for M&A in a much better position, frankly, than in 2008.
How does it differ, Dusty, this sort of emergence from this crisis versus the 2008 crisis, where we did see, a significant period of time, many years actually, before M&A even returned to something approaching where it was before the crisis?
So there are a bunch of differences. I think when we look back, as I said, over time, event-driven downturns like the one we're in have led to faster recoveries in both the equity markets and the M&A markets. And I'd make two observations on top of that. One, in this downturn, what we've seen is private equity has been much more aggressively putting capital to work and has really been leading the charge with respect to M&A transactions this year. If you look at the largest private equity firms, they've spent north of, let's say, $50 billion just since March, and so have been quite aggressive in putting capital to work. They've done whole code take privates like 58.com and MassMobile. They've done minority investments in private and public companies like Geo, like the investment in Albertsons. And if you think about what's behind that, you have record levels of equity capital to invest in the private equity firms with north of $1 trillion of dry powder. But I think more importantly, private equity has recognized that investing in downturns over the last few decades has produced some of the best returns in the industry. So they're getting more aggressive and they're leaning in. From a corporate standpoint, I think the corporates are also in a better position than they were in 2008 to do deals. They started going into the downturn with better balance sheet positions, and those balance sheets have been fortified through the crisis with smart financings. They've turned off share repurchase, and I think cost of capital in the corporate world for acquirers is at an all-time low for most companies. And so I think both private equity and the corporates are leaning in and looking for when we can get through this part of the virus curve to a much more predictable, forward-looking view down the road.
But flip that to the other side, Dusty, for a moment. Obviously, the sellers need to be willing for anything to happen here. If I'm a seller in a market like this, I look at A, the volatility, B, the fact we're obviously, at or near the bottom. What needs to change to get sellers onto the table and saying, yeah, now is the moment to do a deal?
So that's a great question. I mean, clearly you can get a deal done, but as you suggest, the real question is, when do sellers feel like they can get top dollar? It's hard to say. I think that the couple of things that I think need to be in place is financing markets have gotten better, but they need more time to improve, particularly on the leveraged finance side of the market for private equity transactions. We're getting there, but we're not all the way back to a robust financing package. I think second, you need equity markets to stabilize. We've seen extreme intraday and intra-week volatility, and so that needs to start to settle. But I think most importantly, what we really need is greater conviction that we're on the other side of the risk curve with respect to the virus. And frankly, that's going to be the biggest driver, and that can happen if things go smoothly and the businesses open up as they're planning to. That can happen as early as the second half. So, when we look at it, we're pretty optimistic looking forward, right? We do think there's potential for this M&A market to spring back faster than many people expect, similar to what we're seeing in the broader equity market. Because if you think about the M&A market, we largely track the performance of the equity market, although, with a bit of a lag. So, frankly, we're preparing for a pretty meaningful pickup in activity starting in the second half.